Let me give the floor to Gauthier Blanluet. Hoping to pronounce well your name. Please, Gauthier, the floor is yours.
Thank you so much, and thank you to Giuseppe for the invitation. I never miss the opportunity to come here. Milan is a wonderful city, and Bocconi is a so great university. So thank you for the invitation. And I never miss that opportunity, even at the risk of being disappointing, perhaps, or at least not as entertaining as my colleagues have been. Is France going to sign this kind of agreement with Switzerland? Very simple question, very simple answer, and I can stop that. My 20 minutes are over. The answer is probably no. The French Minister of Budget, Valérie Pécresse, declared in November last year, "We are not prepared to consider the proposal made by the Swiss Bank Association because this would run contrary to our principles." This is very French, to our principles. "The Rubik agreements are not consistent with the need for transparency on which our international tax system is based. Fighting tax evasion is and should remain a priority." So that sounds very clear that that France is not going to enter into negotiation with Switzerland. This position doesn't come actually as a surprise, although this hasn't been an easy decision to take. By not signing this kind of agreement, it is quite clear that the French government is forgiving the opportunity to cash in additional revenues at a time when tax revenues are, welcome, and this would range from, it's difficult to say, but it would range from 1.5 to maybe more billion euros. But something has been stronger than temptation, and this something is a mix of politics, policy, and technical reason. Let's go into a little bit of details. Now, the first big issue in France relates to timing and has to do with the presidential election, which will take place in spring this year in France. Of course, as you all know, it's always been very difficult for all governments to take long-term decisions during the period immediately preceding such an important election. And this is all the more risky when we're talking about something which is sensitive, as like the one we are here confronted with. President Sarkozy has been much criticized for having made tax gifts to high net worth individuals in the past, and it would of course be extremely unreasonable for him to take measures that would attract similar criticism right now, a few months before the election. And if I think you should add to that in the candidates program there is something which is coming up, which is a probable change in the taxation of passive income going forward. You may know that in France, passive income may benefit from a reduced rate of taxation, which is levied through something which is similar to withholding tax. We call this prélèvement libératoire. And now it seems that people are coming to the idea that this prélèvement libératoire should be repealed and passive income should be taxed as just normal income, subject to normal rates. Of course, repealing this, which looks like a withholding tax, a one-off payment, would not fit, obviously, with what is proposed in the Swiss agreement. More fundamentally, the deal proposed by the Swiss would not only be contrary to all the initiatives taken by France at the international level, but it will also be totally inconsistent with the recent evolution of the French anti-avoidance legislation. At the international level, since the G20, which took place back in April 2009, France has been in the driver's seat with respect to fighting tax evasion, and in particular, France has taken a sort of leading role in the crusade against tax havens. This opened a new era where transparency has really become the magic word, and now as everyone knows, the indicia of a tax haven is not so much the level of taxation, which is levied locally, but the level of cooperation that the tax haven is prepared to entertain with other jurisdictions, and its willingness to adopt the OECD standards on exchange of information. And it's fair to say that France has been instrumental in that evolution, which is not surprising if you consider that the head of the subgroup dealing with tax evasion at the OECD, the guy who launched and monitored the peer review process at the OECD in the recent past, and who is now at the head of the OECD, is a Frenchman, Pascal Saint-Amand. And as a result of all this, a whole number of measures have been taken as early as in 2010, in order to target transaction being made with non-cooperative states. Just to pick up an example, French source passive income, in particular interest and dividends, are now subject to very high rate of withholding tax when this income is paid into a non-cooperative jurisdiction. And in the same vein, a special tax unit was established in the spring of 2009, following a number of stories around the possible use of, again, stolen data relating to French potential tax evaders hiding assets in Switzerland. And this unit was called the regularization unit, which is sort of disclosure facility you were referring to. French people hiding assets abroad have been given the opportunity to disclose their assets, to pay their tax, and in exchange for this to be relieved from any risk of being prosecuted. This has led to quite a significant amount of revenue, which has been disclosed recently. Out of 7 billion euros reported in that process, the tax authorities recovered more than 1 billion euros in tax revenue. And the interesting thing is that, as one could have expected, the knowledge acquired by the tax authorities prompted a reinforcement of our anti-avoidance legislation in 2011. And in particular, the experience gained by the tax authorities in the special tax unit, led the tax authorities to strongly believe that trusts are widely used to avoid taxes, and that any kind of trusts, including discretionary trust, are basically shams and should be treated as transparent entities. And that's the reason why most recently, last year, very stringent provisions have been enacted with respect to trusts. Basically, the trusts are treated as non-existent, the settler being taxed on income and on the wealth included in the trust. In addition, the amended finance law for 2011 introduced an exit tax applicable to French resident taxpayers transferring their tax residence outside France, and most recently, and looking into the future, the draft of the second amendment finance bill for this year, which should be passed very soon, provides for a substantial increase in the sanctions which are applicable in case of a violation of the obligation to disclose bank accounts opened outside France. And finally, you may have seen that last week France, Germany, Spain, Italy and the UK have declared their common intention to fight against tax evasion in the context of the FATCA regulation, which have been issued by the US. FATCA is based on the principle of automatic exchange of information. France and the other states party to that agreement, including the UK, including Germany, have said very clearly that they would agree to a reciprocal automatic exchange of information with the US based on existing tax treaties. They further agreed to work with the OECD and the EU in order to, I quote, elaborate on the basis of the FATCA experience a common standard for automatic exchange of information worldwide, including the development of standard rules with respect to collection and transmission of information. So this, as you can see, is totally different from what is being done here between the UK and Switzerland and the Germany and Switzerland. And this statement reflects perfectly the French position, and I'm not sure that it's totally in line with what the UK and Germany are planning to do or could be planning to do with Switzerland. Transparency and exchange of information has truly been the sort of cornerstone of the French policy with respect to anti-avoidance. And with that in mind, we understand how unlikely, you can understand how unlikely it is that France would ever contemplate entering into anything close to the Rubik agreement. Now, this being said, even if France had seriously considered a starting negotiation with Switzerland, it would have done so on different grounds. And there is a very strong belief within the French tax authorities that the UK and Germany should have agreed a different deal with Switzerland, and in particular they should have closed the numerous loopholes that appear to be still in these agreements. I will not come back to what has been said before. I would just add one or two comments on additional things which are puzzling, at least in the view of the French tax authorities. First of all, there is nothing, or it appears that there is nothing serious in the agreement which guarantees that the withholding tax to be levied going forward will be computed on the right basis. So there is something which is fundamentally awkward in a system which allows a state to levy taxes for another state without providing that other state with any truly reliable information with respect to how such taxes have been levied. And this is really an issue. The second thing I would like to mention is that, as it has been said before, if the taxpayers do not enter into the sort of alternative between disclosure or paying the one-off payment, they have to leave Switzerland. So that's very fine, but that's, of course, raises an issue because taxpayers may escape the system by transferring assets abroad, which is obviously not the goal which should be achieved. Third, certain assets are not included in the agreement, such as simply cash. If you sell your shares, if you sell your investment, and you put the cash in a safe deposit, this is not contemplated by the agreement, unless I'm mistaken. Insurance policies are not also, at least I think in the German agreement, are not included in the scope of the agreement, and I would be curious to understand why they have not been included. And finally, basically, the agreement target income taxes, whereas wealth tax or gift taxes are not included in the agreements. I will not enter into a discussion with respect to the compatibility with the EU Savings Tax Directive. I will let you discuss this in more detail, and maybe we could talk about this later on. One thing also which could have been difficult with this agreement is that it is not sure at all that it would respect the French Constitution, and in particular the principle of equality of treatment between taxpayers, and in particular when you think that this special unit has been opened and closed recently, offering taxpayers to regularize their position. This would not be consistent with something being put in place in the future for those who have not been disclosing their assets to this unit in the recent past. So I said that I would keep that very short. I hope that we'll have more time for the discussion. Thank you.